The elevator down, that is what Nike stock, Chipotle, Celsius, and Lululemon are taking at this point in time. Chipotle stock fell over 5 percentage points. Here today, that one is showing a lot of topping signal. Less than 2 months ago, Celsius beverage was about 42% higher than where it is right now. That stock has dropped over 42% just in less than 2 months at this point in time. Nike stock down another 3 percentage points here today. That one is now down over 32% so far this year. Lululemon, that's the bonus stock today. It's down over 42% so far just this year alone. So in this video, since these stocks are taking the elevator down, we're going to speak about how low could these stocks go. Usually a lot of times we're focused on the upside in regards to stocks. So we're going to speak about Nike, Chipotle, Celsius, and Lululemon in this video. What's the worst case scenario I see for these stocks? Like how low are they going to go? Could they fall another 20%, 30%, 50%, 60% from where these stocks are at right now? And then we're going to go through what I believe is the worst case scenario for these stocks. So we'll go through like dire situation, and then we'll go through kind of what I think is a realistic situation on how much lower these stocks will go from here. Okay, hope you guys enjoy this video. As always, appreciate everybody joining me. 732,000 plus subscribers, new all-time high. I thank everybody that's watching this video. If you enjoy all my videos where I'm talking about upside, downside with stocks, what's going on in the market, make sure you're subscribed here. Whether you're watching this on your phone, your iPad, your tablet, your computer, wherever you're watching this, make sure that subscribe button is hit, okay? So where we're going to start out here, we'll start with Nike. This is a stock I've personally been buying a lot of shares of recently, and I'm getting absolutely wrecked on it. Down 27.5% on this stock, down $12,000. So this one is hitting me and it's just nailing me right now, okay? So in regards to Nike, where I want to start here is the valuation. So forward P on the stock's about 21-ish, right? Now, obviously, when you think about forward P, it's future projections, right, of where earnings per share is going to go. So it's never a guarantee, but 21, this is a weird situation for Nike because where you look at many stocks in the market, they're kind of valued around here, but the issue is Nike has a freak situation going on right now where their revenues are actually expected to go down over the next few quarters, down as in negative. Now, if you look at an average stock in the market, their revenues are not going negative, but it's Nike on the other side. And so you got this incredible company, incredible brand, one of the most successful companies in the world. So you would assume after this next few quarters, they're going to get it turned around and they'll be an outperformer again. But how do you value a stock like that when they're in this type of predicament where, literally their revenues are expected to go down here in the short term? Now, if we look at the Rona lows for Nike, it was around $60 a share. That was back March 23rd, 2020 in the depths of the Rona crash. Very important area to understand where Nike went down to in that situation because it's about $73 here today. It's the lowest it's been really since that Rona crash now at this point in time. And it just seems like it goes lower and lower and lower. So it's important to understand we could go all the way down to $60 in this baby and we'd be right back down to the Rona crash levels on the stock. Next up here, this is what we're looking at here is 5-year PE ratio, okay? And if we look at the PE ratio of Nike over the past 5 years, guess what? This is the lowest it's been in the past 5 years when it comes to Nike. The PE ratio on this one's about 19 as of right now on a trailing 12-month basis, right? Which literally is the lowest it's been today. Like literally today, the day I'm recording this video. The median is 34 over the past 5 years for PE ratio. So we're massively under where the stock usually trades at PE-wise, but you got to understand it kind of makes sense in a way because, hey, the company's going through tough times right now. Revenues are expected to go negative here in the short term, and so being that that's a situation, you can understand the PE ratio being considerably lower than where it traditionally has been at, right? Now, next up, what I want to show you here is looking at earnings per share. It's expected to be down 43% in this quarter they're about to report. Now, do keep in mind they got a lot of cost-cutting measures going around. So if there's one area they might be able to beat at in this upcoming quarter, it might actually be earnings per share. But the revenue is expected to go down about 10% in this upcoming quarter. And Nike basically said it's going to be down about 10% in their latest earnings. So Nike already had kind of a scare the market event. This latest earnings in terms of the guidance was so bad that it really freaked the market out in a substantial way. And so if you're thinking about kind of on a bullish angle, that's something to be somewhat bullish about. Then Nike at least got that out of the way, right? Now, check this out. This is a problem with Nike is what if, they're expecting revenue to be down about 10% in this quarter they're about to report. What if that 10% down continues for the next few quarters after that? Analysts are expecting only 6.5% down that following quarter, then 2.6% down. But what if the consumer doesn't get better? What if Nike's business doesn't turn around in the short term? And what if they report another down percent number the following quarter, right? And they're like, you know what, we think we're going to kind of be in line with where we were at as far as revenue shrink for the rest of the year. That would be an ultimate panic situation in regards to Nike stock. If you think people have freaked out so far in regards to Nike, that's a whole new level of panic that would ensue if that were to happen, right? I don't expect it to happen, but if it did, I'm just telling you, there'd be a whole other level of panic. So here's the worst case scenario for Nike stock in 2024. Worst case scenario is $50 to $55, which today this stock's about 73, so that would be a lot of downside. But that's if we get this ultimate panic situation. Everybody freaks out, right? On a massive revenue shrink of 10% for the entire year, right? The realistic bear case for this year, in my opinion, for Nike is around $60, $65. We get one last flush in the stock maybe over this next 3 months. We kind of get in that 60, 65 range, and then that's about it. Okay, so that's kind of what I foresee there. Now, with that being said, I'm going to likely buy Nike stock every week for the next 6 to 9 months. Like, it doesn't matter if the stock's 60, 50, 70, 80. It's all a steal deal for a long-term investor like myself. So I'll be buying the stock, pretty much week in and week out. And one last thing I want to cover in regards to Nike specific is brands like On and Hoka. We haven't really seen those brands get hit yet, right? And so it's kind of giving a false illusion that like Nike's in trouble, but these other brands aren't. Not really, okay? You got to understand who's the buyer of Hoka and On products, right? I was at Dick's Sporting Goods recently, and I saw a lady, mid-40s buying a couple pairs of Hoka shoes, right? That's who is really buying this. It's a little upper middle class, 40, 50-year-olds, right? Maybe some in their 30s. That's Hoka and On's customer base. So those ones haven't been as bad hit by inflation because those are smaller brands. So they're more of a niche market. Somebody like a Nike, everybody's Nike's customers. Rich people buy Nike's products, right? People that are, let's call it not in the best financial situation buy Nike products. The middle class buys Nike products. Everybody buys Nikes. They're like a Starbucks of apparel, right? Hoka and On, they're much more niche and they cater much more to the middle class, right? And so that's when you haven't really seen those ones hit as bad because we haven't really seen job losses in that specific group in any substantial way yet. Doesn't mean it can't come over the next 6 to 12 months, but yet we haven't seen that yet, right? And additionally, on top of that, inflation doesn't hit the upper middle class nearly as much as the middle class and below. Those are the folks that really get hit hard. And that leads us to Lululemon. Now, Lululemon's been a company that for the longest time, they catered to the upper middle class, right? That, prior to Rona, that was honestly who Lululemon's customer base was. It was the upper middle class women, right? And nowadays, it's very different. Lululemon, they now cater to, honestly, all customers of pretty much all income levels, but specifically the middle class now is Lululemon's customer base as well. And the reason they had to do that is you only have so many in the upper middle class that will buy your product. If you want to become a giant corporation and you want to push to a $10 billion run rate on revenue or above, you better make sure everybody's your customer base, or at least the middle class. And so that's what Lululemon had to do. The upper middle class got Lululemon to like a $3-4 billion run rate. But you want to get it up to 10 or so like they did this past year, you got to attract more than just upper middle class folks. You better start attracting the middle class, right? Well, that's great at first, but then if the middle class gets sliced and diced by inflation and eventually they run out of money to spend, then your numbers are going to start looking really bad really quickly, right? And in regards to Lululemon, the stock just continues to fall. It's now under $300 a share, right? And it's not that far away from that 2022 crash price when the market was just getting leveled, right? Back then, it kind of reached $260, $270 a share. It's like you get one bad week with Lululemon stock, next thing you know, you're going to be in the 270s or so, right around that 2022 crash. Now, keep in mind, if we go back to the Rona crash, it was just under $150 a share. So if we went all the way back there, that's about a 50% retracement from where we're at right now. Okay, so just a little food for thought in regards to that, right? Now, for Lululemon, they got two problems here right off the bat, okay? One is analysts are expecting revenue growth to accelerate over the next few quarters when it comes to revenue and when it comes to earnings per share, okay? Now, if that happens, great, but the issue is there's a viewpoint that actually the consumer might be getting weaker as this year ticks on, and if that's true, if that's accurate, oh boy, watch out, okay? Because then Lululemon is not going to show accelerating revenue growth and earnings per share growth. What they'll actually show is shrinking earnings per share and shrinking revenue growth, right? And so that's a whole other dilemma that could potentially happen. And keep in mind, Lululemon's revenues haven't been negative. And look, I don't even remember the last time Lululemon's revenues were negative. Imagine if Lululemon came with a print and somehow their revenues went down in a quarter. That would be pure panic in regards to Lululemon. Now, Lululemon also has an issue here. If you look at Google Trends, honestly, this is looking at the United States, Google Trends for Lululemon, right? It's stuck for the past 2+ years now at this point in time. So clearly interest in Lululemon's products has kind of peaked, at least in the short term. It doesn't mean 5 years from now or 10 years from now, it's not going to be much higher than today. But for at least the moment, and when I say the moment, the last 2+ years, it's completely stuck, right? And I do think part of that, just to be honest, is the consumer getting hit so hard with inflation over the last couple of years, so they're not as interested to spend $100+ on yoga pants when you can get them from a lot of other places for a lot cheaper, right? Worldwide, if we look at Lululemon, we've seen a little pickup over the past 2+ years, but not really the pickup you want to see. Lululemon's expanding more and more worldwide, but I mean, just, you would want to see a lot stronger pickup than that, just to be honest, with Lululemon going more worldwide. Now, that leads us to our next thing in regards to Lululemon. I think of these stocks we're talking about here, this is, one or two of the stocks that are in the most precarious situation because of Lululemon's brand, right? And Lululemon's done well building out their business to about a $10 billion run rate, right? And they did it on the back of not really necessarily standing for anything or really being known for anything other than just, having really good leggings, right? If you think about Nike's brand is like, I'm a top tier athlete, right? That's what they've always wrapped their brand in since like the 1980s, right? They're going to buy out the best athletes in the world. They're going to buy out the best sporting events, and Nike's branding is going to be everywhere. And so that's what Nike stands for. Lululemon kind of stands from a white blonde in LA. I drive a used Range Rover, and my hubby makes, $325,000 a year. Like that's Lululemon's brand right there, okay? I mean, it's just got to be honest with you guys. And so how does that brand handle a situation where consumers getting sliced and diced by inflation? I don't know. We're going to find out, right? So far, based upon that latest earnings and that latest conference call to Lululemon, it sounds like it's going to be a little trouble. I don't know, man. We'll see, but it's a very precarious time on what happens with Lululemon's brand now, right? So Lululemon, worst case scenario for this year is the stock goes down to $150 to $180 a share, which 150 from here, that's almost 50% down, right? Yeah, that's worst case scenario. This one will get hit very hard. And in order for that to happen, revenues probably got to go negative or maybe very slight growth, and that would cause panic in regards to Lululemon. Now, realistic case, in my opinion, for Lululemon, bear case that is, bear case 195, 225. Let's assume they miss this upcoming quarter. They also guide down. Yeah, you could get this stock to definitely go under 250 and maybe in that 220 range at that point in time, which would be, no fun for Lululemon shareholders. But if you're a buyer for the long term and you believe in that company for the long term, then maybe it's a great buy the dip opportunity, right? That leads us to Chipotle. Chipotle was a train, and that train has lost momentum. Now, Chipotle is still trading at about an $82 billion market cap. The train momentum has stopped, and it stopped at a really bad time because they even had the stock split recently. And so the fact that they had that massive 50-1 stock split and the train momentum still has lost, it's not good. So sitting at about an $82 billion market cap, the PE ratio is sky high on this one, 63 for this company. Now, Chipotle is going through what I would call a borderline crisis right now. There's so much bad publicity all over social media, which social media is just a fancy word for what everybody actually sees, right? If you were to go on TikTok, Instagram, YouTube over the past month or two, so much bad publicity. It's all bad publicity, really, in regards to Chipotle, right? And some people say all publicity is good publicity. I don't know about this one, okay? Because there's just been countless TikTok videos, Instagram videos, YouTube videos showing that Chipotle's sizing is, let's just call it, not quite there the way it used to be. And this is causing a very bad brand kind of damaging situation in regards to Chipotle, where people are feeling like Chipotle's gone up on price so much over the past few years, but they're giving you less product than you've ever gotten before, right? Which makes people very upset and not as likely to do business with that particular company, right? Now, this is not the first crisis type situation Chipotle's had to go through. They had to go through a crisis type situation many years ago, and I remember seeing this one and watching it all play out, and I knew Chipotle stock was going to crash massively as soon as I started to hear rumors about this, and sure enough, that stock crashed. But Chipotle, they had an E. coli outbreak many years ago, and this caused the stock to get absolutely hammered. And if you look, right, so that stock, from basically around the time the E. coli situation happened to just going like a year later, I mean, the crash was insane in that stock for about a year, right? And so here we are about a month, 2 months deep into this new crisis, and could we see a massive crash in the stock over the next 10, 12 months? It's a potential, not a guarantee, but it's a potential, right? And then the stock started to come back, and then it had crashed 2.0. And in between that time from where the E. coli outbreak news kind of started to where that stock went to over the next, couple years there, right? It was a 61% drawdown in Chipotle stock during that particular time. 61%. Massive, absolutely massive. No, prior to that, the stock had a parabolic multi-year run. Look at this. This is showing you 2010 up until kind of around that E. coli outbreak situation, right? It was a parabolic move. The stock went up 700+%, right? And that was a moment when Chipotle went from people thinking this was going to be more of a niche related company to like, oh, this is going to be for the masses. Like, everybody's going to eat Chipotle. Like, everybody's Chipotle's customer base, where previously people kind of thought like Chipotle might just kind of be in like a niche market, like the top 10, 20% of income earners might eat it. And now you see Chipotle's all over the place, right? I mean, you see Chipotle's in places that you just did not see Chipotle's 10 years ago, right? In different areas and whatnot, right? Now, this is what's interesting is we're just coming off of a parabolic multi-year run, right? If you look at the stock 2018 through the first half here of 2024, it was a parabolic run, 900+% the stock ran in that amount of time. So the setup between the E. coli outbreak, right, and this really bad branding around them shrinking the sizes and portions of what they're giving you as a customer, right? It's fascinating to see the setups, right? Like parabolic moves into those situations, and then just a super brand damaging situation that could cause brand damage for, keep in mind, if you are branded as, you're ripping customers off, you've gone up in your price a bunch and you're not giving as much. If people are viewing you that way, just keep in mind that could last for several years. It's not like that lasts for a month or two. And then as a company, let's say Chipotle wants to try to fight back against that by doing a lot of marketing and advertising, well, then that's going to hurt your profitability in a substantial way. So these are just kind of, factors to kind of keep in mind here, right? Now, additionally, this is another issue with Chipotle is it's not like it's trading cheap. The trailing 12-month price to earnings ratio is at 64 for this stock, right? 63, 64, somewhere around there. So we're dealing with the situation in regards to Chipotle where the valuation is sky high on the stock at a moment when suddenly they're having this very damaging brand situation happen that, and you can read the comments of all these Instagram, TikTok videos, YouTube videos that have come out the past month or two and have gone viral. The comments are insanely negative. There's not very many people sticking up for Chipotle. It's just countless people saying, notice this over the past year or two. They're getting cheap on their portions, these sorts of things, right? And so, this is kind of food for thought when you got a very high valuation. That can cause for some pretty epic crashes. So Chipotle sets up in a tough situation here. Because if you look at their gross margins, 30+%, net margins, 13%+, right? If they load up people's bowls and their burritos, right? And say, okay, man, everybody's on us right now. The whole world's paying attention to what we're giving for portion sizes, so just over portion, right? Okay, you can do that, but then you're going to hurt your margins, right? If you want to over portion chicken and steak and all these different things, you're going to hurt your margins, just bottom line, right? Now, on the flip side, if you don't load up people's bowls and burritos right now and kind of almost go, overboard with the portion sizing you're giving there, well, you're going to get bad press because then everybody's paying attention to this right now. And so if you give somebody a small portion, guess what? They're going to take pictures, they're going to post it on their Instagram, their Facebook, and wherever else they post stuff, right? They're going to share it with their friends and family. Oh, I went to Chipotle today. Yeah, what they're saying is right, man. Look, here's a picture I took. Look at this is all they gave me in my bowl today that I ordered on the app. Like, that's a problem right now, right? So you're either going to get more bad word of mouth, or you're going to hurt your margins. You're really stuck in one of those two situations here if you're Chipotle, right? Now, additionally, it's even worse because minimum wage just went up in California. So it's actually kind of confusing because here it says effective January 1st, $16 an hour for all employees. But then it says fast food restaurant employees effective April 1st. So you're thinking, oh, 16? No. Look at this. Starting April 1st, 2024, all fast food restaurant employees who are covered by the new law must be paid at least $20 per hour. Guess where Chipotle has the most restaurants? California. And so now, if you go to any California Chipotle, just understand the workers in there are all getting paid over $20 an hour, or we just say at least $20 an hour. Right now, you tack on all the other cost of having an employee, which goes way past just the wage. You just got to understand all those folks are getting $20 plus an hour, right? And the quarter they're about to report is the first quarter that's going to really hit this company, right? Because it just went into effect in April 1st. So we're going to get the first glimpses of what this is going to mean for Chipotle's profitability, right? And it's not like it just happens for one quarter. It's like next quarter you got to pay these employees $20+ an hour as well, and the next quarter, right? So that's going to be very interesting because it's like, okay, if you're stuck in a situation where you got to start loading people's bowls and burritos and you're hurting your margins and then you're getting hit with minimum wage, what do? Do you go up on price again on your customer base? Whew, that's brutal. That's a brutal decision, right? So Chipotle set up in a weird situation here. So I would kind of say worst case scenario for the stock, it maybe goes to $25 to $35 this year. That's a worst case scenario. The realistic bear case for the stock in 2024 would be $45 to $55. Now, of course, there's also a potential Chipotle goes up, right? No different than all these stocks. We're only really speaking about the bad downside in this video, but let me just mention the upside for Chipotle. A situation where the publicity was nothing but good publicity. They got more customers than ever. Their comps go way above where people are expecting that. All the minimum wage price hikes that are pretty substantial, actually, when you run the numbers on that. Let's say that actually somehow doesn't hurt profitability and margins, and the companies just go up and up and up. Yeah, if that were to happen, then maybe the stock goes higher. But if I'm gonna guess here, with the 63 PE and the wage pressure and all the bad publicity, I think the company's going to be in some tough struggles for the remainder of this year and maybe into 2025 as well. So that's kind of what I'm thinking in regards to Chipotle. As far as what I'm rolling with in the public account for my put position there as of right now, I'm rolling with these ones. They expire in March 21st, 2025, $63 puts there. And I'll ride those ones, these particular ones I have now at this point in time. I'll ride them into Q4 and I'll ditch them in Q4 at some point in time. And then at that point, I might re-hedge against Chipotle again, depending upon where the stock's trading at, or in kind of what's going on with the numbers, or I might just roll that into something else because usually I do all new fresh hedges in Q4 anyway. So we'll see kind of where that one goes, okay? That leads us to Celsius Beverage. So Celsius, the stock's down 20+% in the past month. Not only that, stock's down about 42% or so just in less than 2 months. It's devastating, kind of what's going on with Celsius stock. And it just seems like day after day, the stock goes lower and lower and lower, right? Now, the first thing I'm going to be honest with is Celsius is a top tier stock. And I mean the top tier of top tier. The stock, even after this recent crash of 40+%, right? The stock's up 3,600% in the past 5 years. Now, for some reference, NVIDIA, the world-changing, game-changing NVIDIA, the most talked about stock in the market the past year, right? NVIDIA is up 2,800%. So Celsius Beverage over the past 5 years has outdid the beast that is NVIDIA. That's incredible. Not only that, it's outdone my Elf on a shelf, right? It beat my Elf. I'm sitting on a little less than 2,700% gain. And once again, Celsius at 3,600% even after this crash. That's incredible, okay? So we got to give Celsius some dang respect before we start talking about the downside and kind of the current state of Celsius, right? Now, the first thing you got to understand about Celsius is they're a big dog now. right? They are a big dog. Ever since 2022, back in August 2022, they basically made a long-term distribution agreement with Pepsi. And whenever you make that long-term distribution agreement with Pepsi or Coca-Cola, it usually means you're there. You're now a big dog. Your distribution's likely in just about every convenience store out there, just about every, at least on a domestic front. I don't want to speak about international. That's a whole other opportunity there. But on the domestic side, once you're in with Pepsi for distribution or Coke, you're likely in all the convenience stores. You're likely in all the food stores. You're likely in Walmart. You're in Target, all those companies, right? My baby just came out. I got to take care of them. Hold your horses. Now, the other issue when you do one of these big distribution agreements as somebody like a Celsius is usually that next year, year and a half, you see your revenues fly to the moon. And the reason is a lot of times Pepsi or Coca-Cola, they can get you into so many more locations than where you're at previously. They can also get your SKUs up in a massive, massive way. And so it almost is a little bit of a pull forward in demand, and it can kind of give you a little bit of unrealistic revenue growth in the short term, which makes a lot of people very excited about your stock, but then they kind of get hit with some reality. The come down from that maybe a year after, 2 years after is sometimes a little tough because the growth rates kind of fall off in a massive, massive way. Now, in regards to Celsius, I spoke about it on a video a couple days ago here on the channel. I spoke about 12 stocks in that video. Celsius is one of them. And one of the points I brought out there is the setup for Celsius for the remainder of this year is horrible. Horrible setup. And the reason being is analysts basically have quarter after quarter for the next 4 quarters, growth accelerating from 23% to 25% to 27% to 29%. That's not a good setup. That's not a good setup at all. And the reason being is if Celsius is actually in some, let's call it more trouble here in the short term, what happens if they grow? Let's say they do hit this quarter's numbers, 23%, but let's say next quarter they're like, you know what, not going to quite be there, and they report 20% or 19% growth. Well, when you're expecting 25%, that's not good. Then people start looking and they're saying, well, that December quarter, there's no way they're hitting 27%, right? So the setup for Celsius is not good at all in the short term here, right? Additionally, Celsius is at a forward PE in the 50s right now, right? Now, keep in mind, Monster's forward PE for many years during kind of its growth cycle was kind of in the 20 to 35 range, right? I remember Monster paying like a forward PE of like 27 at some points, 33, some of those back when I was building out my Monster position. Like that's like over a decade ago now at this point in time, right? And so Celsius is trading at a pretty dang high forward PE, but the growth rates have been astronomical. I mean, look at the trailing 12-month revenue growth, 80+%. Once again, a lot of that could be that distribution agreement, getting into so many new locations, so many new SKUs in these different locations, and it's like a huge bump up in your business, but then you kind of have that come down, right? Now, there's a two-sided worry, I would say, in regards to Celsius here. One is revenue growth, right? Where's revenue growth for this company going to actually be at in the coming years? Because you got to understand, Monster, much of its history since I follow Monster, the company's revenue growth has actually been under 20%. It's been kind of in the, I would call it anywhere from like 8% to about 18%. Celsius is becoming a more mature company. You see that with the distribution agreement with Pepsi a couple years ago, right? And you're seeing it, obviously, you can pretty much go into just about any store in the United States and you can get Celsius now, right? That's signs of becoming a more mature company and having a ton of different SKUs, right? I mean, shoot, I was at Target last night. Celsius, the amount of different flavors they have in those stores now. They have end caps with Celsius. They have a huge section in the energy drink category now. Actually, arguably, probably in that Target, I think there's probably a bigger Celsius section for individual Celsius than Red Bull or Monster, right? Or even Reign. Like, it's insane. So revenue growth, there's a worry there, right? But the second worry is margin growth. Let's say there's a situation where Celsius management views right now as a time that, maybe revenue growth isn't the strongest, so they got to capture market share. Well, then you do discounting. You hurt your margins, right? And so people invest into these sorts of companies, you got to understand, for the revenue growth and for the margin growth. And if you're missing either one of those, then, if revenue growth isn't as strong as you expect or margins even going down or stagnating, people don't want to own those stocks during that particular period, right? Remember, a lot of Wall Street kind of traders worried more about the short term. So that could cause a lot of pressure on this stock in general if either one of those situations is playing out here over the next kind of few quarters. So my opinion in regards to Celsius is worst case for this stock this year is it goes to like $30 to $35, which is actually where the stock was around the time they did that Pepsi deal. around the time, if you go back and look at the stock chart of where the stock was back to kind of like August 2022 and kind of, later 2022, it was kind of in that $30 to $35 pricing. So it would go back there in that situation, right? And that's worst case scenario. That would be, once again, revenue growth has to continue to disappoint for the next few quarters. Additionally, margins have to get hit. If you got that double there, people are going to freak out in regards to this one, and they'll continue to sell, and the buyers just won't be there because they're going to be worried about two sides of the story, right? Now, realistic bear case scenario, I see if the stock is kind of $45 to $50 range. Let's assume next quarter's not that strong. They have to guide down, something like that, pull down some numbers. Yeah, you're probably going to that $45 to $55 pricing at that particular time, which could be very attractive for long-term investors, okay? These are some trophies I signed last week. We got in my private group, we got 5 folks that just hit 6 figures club, and we got 2 new folks that just hit $1 million plus in their portfolio, 7-figure club. So if you want to learn from me on a much deeper level, you enjoyed today's video, got a lot of value out of that, you get a lot more value out of my private group. That's going to be pinned comment down there. You can fill out an application if you're looking to join us in there, and we'll see if you're a good fit. And these are the awards we send you once you scale up to $100,000 plus in your portfolio. You get the Diamond Award. That's a heavy beast. I actually got that right behind me right here. And then this is a 7-figure club award, which we have, I think we've shipped over 100 of those to private group members over time that have scaled their portfolios to $1 million plus. And then I lost count of how many people have hit 6 figures plus now that have joined my private group over time. It's unbelievable. So yeah, there'll be pinned comment down there if you're looking to get all my premium courses, learn everything I got up here, access to Discord chat, all that good stuff. Much love and have a great day.